Welcome back to another episode of Balance Your Wealth. This week, we're talking interest rates. As you know, interest rates touch almost every major financial decision, but most people only notice them when payments get painful. Today, we're unpacking how rates influence home purchases, car loans, cash savings, CDs, and refinancing, so you can make smarter moves with the money you already have. If you've been wondering whether to act now, wait, or rethink the whole plan, this episode's for you. So let's go ahead and bring in the panel. This week I'm joined by Sean, Bob, Nora, Tyler, and Nick. We're going to start off with segment one, the house question, buy now or wait. When rates are elevated, a lot of families freeze. Bob, want to talk us through how someone should think through buying a home without letting headlines make the decision for them?
Yeah, Ryan, I think that's a great point right there, not letting headlines make the decision for you. I think the beautiful thing about personal finance is it is personal. And regardless of where interest rates are at, you shouldn't make that be the determining factor in buying a home or not. Just like you shouldn't have sold your home and went and bought a new home when interest rates were at historic lows, 5, 6, 7 years ago. You weren't just going to sell your house just to get a lower mortgage. Same thing here. You go out when your family wants to move. If you need more space for your kids, you need to get out of a home that has stairs and get to one level. You want to change states, whatever it is, that's a determining factor. But then the bigger question is, how big of a mortgage should you have, right? Should you use some of your other resources to pay it down depending on rate? Should you speed through the payback or make it a 15-year mortgage instead of a 30? Those are much more important questions. But I think delaying a purchase just because of interest rates is going to leave you stuck for life because that's not a way to go through it.
Yeah, and I think if people are waiting for mortgages to get to 3% or lower again, you might wait forever. That was a very unique time period from 2008 through 2022. So if that's the interest rate environment that you grew up in, and that's how you purchased a lot of homes, like myself, then you're going to be waiting potentially for perpetuity to get back down to that rate. So I agree with you 100%, Bob. I think a lot of people get stuck in hey, it's got to be a 30-year mortgage because that's what everyone does. There's so many different strategies. I will say our advice has changed a little bit. When people were paying 7% or more for an interest rate, then we're going to tell them it probably makes more sense to put money down the house. We
Mhm.
tell people that are near retirement, they've got a 2.7% mortgage. If they won the Powerball tonight, they shouldn't pay off their house. So different interest rates are going to impact how much money you put down, how long you finance it, and ultimately, how do you achieve your goal?
I think another point that people miss while they're sitting there waiting for rates to come down is homes can keep appreciating,
Mhm.
and especially when rates drop, home prices usually start going up a little faster. So you're almost waiting for something that's not going to be there when the time is per se ready or interest rate is where you want it. So again, something that I think people miss when evaluating that decision.
Yeah, that's absolutely it, Tyler, right? And that goes back to my point, right? Like you can't let the interest rate be the main driver of your decision. If you find the house you love, find a house that works for your family, whatever it may be, go and we can deal with interest rates because whether they go up or down in the future, it's outside of our control, but we can always do things in the future, even if you're in a higher interest rate than you may want. If they do go down, then you can talk about refinancing. There's all kinds of flexibility you have long term.
I think the big scary area is if I'm looking for a $500,000 house at 6% and then interest rates go up to 7, I better not be looking at a $500,000 house anymore. Right? I've got to
Hmm.
adjust my budget. So that's how interest rates will impact your decision because we want to make sure that we're not paying more than 30% of our take home pay on our mortgage so that we're not house poor. So that's one of the ways that it may affect our decision making is looking at how much house I can afford.
Awesome, great conversation, guys. I think that's really helpful to kind of frame it as, make that decision for what makes sense for you and your family and fits in your budget versus, hey, interest rates are high or low. This should be the only thing that impacts my decision. Moving on here, we're going to get into purchasing cars. We all have seen how expensive cars have gotten over the last, call it 5 to 10 years. And a lot of people feel pressured to either finance quickly or just pay cash and move on. Tyler, you want to talk us through how we should really think about evaluating a car purchase when borrowing costs might be a little higher?
Yeah, so I will not buy a car unless I get 0% financing. Like, it's just not gonna happen. I will wait until 0% financing is available, or I'll keep my car for a certain period of time. Um, I think financing a vehicle at, rates right now, 7, 8, 9%. I've seen, some people, just doesn't make sense. And companies will run financing deals almost every year. So don't rush into buying a car. Take your time. Deals are around every corner. That's the big thing. I always look for 0%.
Yeah, and Tyler, on the flip side, if you're somebody that maybe your car broke down and you don't have another choice, you can't wait. One of the points you mentioned earlier was that home prices appreciate, right? We see those around 3 to 5%. Now, when you think about taking out a loan on a car, depending on what interest rate you're getting, that's a depreciating asset. So are you really going to pay the interest on a depreciating asset versus like a mortgage, right, where it's appreciating? So that's one thing we like to consider, especially if you have enough, liquidity that you do have the ability to put more down on a car. That's something to consider.
And I'll play a little bit of a devil's advocate here, because cars are a big part of our monthly expenses. Some people have to pay an interest rate. It's always great to go to the golf course or the gym and hear people like, "Oh, I paid cash for my, new Mercedes." It's like, good for you, bud. But a lot of people do have to finance cars. So the key driver is, I want to make sure I'm not spending more than 10% of my take home pay on my vehicle. And so if interest rates are high, I may not be able to get that $80,000 Jeep Wagoneer. I may have to look at, a $40,000 minivan. Not an easy conversation, but honestly, that's really what you need to be able to do is look at what can we afford based on the interest rate environment. And to Tyler's point, sometimes you get those 3% offers from new car companies, or 0% down, whatever it may be, for some of those new cars. And that's a great time to take advantage of situations. But ultimately, a lot of these interest rate discussions come down to hurdle rate. Am I going to get more with my money being invested in a brokerage account or a high yield savings or a CD? Or am I going to be better off putting that money towards a car? So if I'm paying less than 3% for a car, maybe it's not a bad decision. If I'm paying, 6, 7, 8, 9%, it's almost never really a good idea. So it's making sure that you can afford the car, you're not overpaying, and that you're living within your means.
Yep. And one final point I'll add in here too is a lot of times when you're going, especially if you're buying a new car from a dealership, even getting the financing, they can get you a better deal on the price, even if you finance it to start and then pay it off after the fact. So utilizing some of those benefits that come from the car company can be helpful, even if you don't intend on keeping that loan for an extended period of time. So just see what offers they have and how you can work the system a little bit.
Awesome. Great conversation, guys. The last thing I'll add on that one is don't feel pressured based on what your friends are doing. We all have the friends with the $80,000 SUV and $80,000 trucks, and we're like, how do they afford that? Like the $1,000 a month car payment has become way too standard nowadays. So if you're like me, you avoid that at all costs. But we're going to move on to money markets, CDs, and safe cash. Sean, higher rates have made cash feel more rewarding again. So how should someone decide between a savings account, money market, CD, or just leaving the money where they have it in their checking account?
Yeah. So honestly, from 2008 through 2022, your savings account, your money markets, were paying like 0.2%, right? Some people are getting 0.1. They really had little to no value. And then 2022 came around, rising interest rates, rapid inflation, and banks, good for them, were able to offer people 5.25, 5.5% on money markets. CDs got a lot more attractive. Cash sitting around became an actual asset rather than just something that was weighing down your portfolio. So what we always like to do is say, what is the rate of inflation? I got to make sure that any money I've got sitting aside is going to be earning money, because if it's sitting in a low yield savings account, less than inflation, people think that's the safest investment, but it's actually the riskiest because you're losing value every day. And so there's lots of different ways to do it, whether that be a money market, high yield savings account, CD, or a low risk brokerage account. Having your money invested in the market, still providing you liquidity, access to it, but making sure that you're getting a rate that's higher than inflation and adjusting it based on how much risk you're willing to take. So good for banks for being allow it. I will tell you, met with a client about 2 weeks ago. What people don't know is that as interest rates have declined, those money market CD rates have come down. And so this client was in what they thought was a 4.75% high yield savings account. And I said, that seems a little high. You should probably check that. Well, it had dropped, and it dropped to 0.45%. banks don't come out and advertise this, right? They only advertise it to get your money in when interest rates are high, but that yield changes throughout the year. So if you put money in a high yield savings account or a money market or a CD, my recommendation is go back and check to make sure that you're still getting as high of a rate as you thought. If not,
Mhm.
brokerage account or something like that may be a better option for you.
Yep. And I'd even add on that, like a lot of our clients are in their like highest earning years, right? Whether it's right before retirement or we're in the middle of doing maybe some Roth conversions and like very strategic income planning. And if you do have a large cash pile, it's really important to think about the taxability of that income, which, again, like Sean said, in the 2008 to 2022 environment, didn't really have to worry about the taxes coming from all the interest on your savings accounts. But it's like now it's, it has been a line item for the last few years, like something worth paying attention to. And that also makes you kind of peel back the onion a little further and say, do I want taxable income from CDs, or does a treasury, like a T bill, make more sense, or even a T bill backed money market fund that has the pass through treasury benefits? So, all of those things are part of the calculus, and a lot of it depends on your income. How big of a cash pile is it? Is it going to be, are you going to keep the cash pile for 6 months to a year, or is it just like a month and it's not really worth worrying about? So all of that is part of the dynamic there for sure.
Yeah, and I'll add just from a financial planning perspective too, like to Nick's point, understanding the timeline for the cash is important, but there can even be situations where, I had a client that sold a house and had $500,000. It was just going to sit for a month and a half for until they bought a new house. And in that circumstance, yeah, it is worth just throwing into a high yield savings account for, 45 days to get a few $100 or a couple $1,000, right? So just being mindful and understanding that there are a lot of options out there that provide different levels of liquidity based on your goals, but certainly something that it's worth talking about, because if your money is still sitting getting 0% in checking or a savings account at any of the big banks, it's worth going through and understanding what options are out there.
Awesome. Thanks, guys. Moving on here, kind of hand in hand with the house conversation we were having earlier, and anyone who's purchased a house in the last 3 or 4 years probably has been considering, does refinancing make sense? Nick, has someone who has gone through this process recently and just refinanced your house, maybe you can give us some perspective on how you thought about making that decision, whether you think it still makes sense given the current interest rate environment.
Yeah, yeah. So personal experience here, somebody who walked away from a sub 3% mortgage in a different state to move up to Michigan. I am very intimately aware with the interest rate dynamics and always looking for ways to um, maximize my situation. And one of the things that I've found just with refinancing in general is like, the rates change every day and you can drive yourself crazy trying to like catch it at the bottom. It's almost like hits the day trader part of you. It's like, oh, I got to get this right. Oh, I could have saved $50 a month if I would have locked yesterday or tomorrow. And so I'd say don't worry about that too terribly much. Really just think about like when the rates make really big moves, and they have made a lot of big moves even this year in 2026. We've seen rates started off the year, mortgage rates around 7%. They dipped down to below 6% briefly. And then we decided to have a geopolitical event or two that has pushed them back up to 7. So, I mean, that's a huge move. 1% doesn't sound like a lot, but that's actually like a whatever, 15, 20% difference right there just in a few months.
Mhm.
So, it can make sense. I think that there's a lot of reasons that both political parties have to try to push the mortgage rate lower to help affordability. Is kind of at the forefront of our current um, social political environment here. So I think there will be opportunities going forward. And one of my, I don't know, if I had to give some hot tips for how to refi and do it well, I'd say try to keep your mortgage balance exactly the same when you're doing your comparisons between lenders. Say, like, my mortgage balance is, to say, like $300,000. Say, like, okay, I want to keep it exactly $300,000. Don't roll all these crazy extra closing costs and fees and stuff into the new mortgage. Just pin it at that. let me know exactly how much I need to bring to closing and tell me what I can do to get the lowest rate. And when you make lenders compete that way, first of all, they're kind of on their heels because they love just rolling fees into the mortgage balance. And second of all, it just really makes it easy for you. And on that, the second hot tip is try not to escrow things. Talking about that hurdle rate, Sean, in a higher interest rate environment, the escrow account was the enemy of people because you're paying them to hold your money for you and not earn anything on it versus escrowing those funds yourself if you're disciplined, to make a little bit extra, maybe have it invested, et cetera, to help pay for those things like homeowners insurance, property taxes, et cetera. And a lot of times, some lenders penalize you for not escrowing, and some of them are able to waive that. So I just asked, I said, hey, I'm not going to escrow. Don't penalize me on this. And some of the lenders I talked to were like, it was like a 0.5% penalty for not escrow. It was like a huge mover in the mortgage rate. And so,
Mhm.
anyway, it's just something to keep in mind, something to look at when you're going through all these, interest rate gymnastics. But it can definitely make sense.
Okay.
I would say like something about like when you do refi, you don't have to take it out to 30 years. You can do 25, right? Like it doesn't always
Mhm.
have to be pushing it back out. Um, uh, think about how long you're going to be in that house. Like if you just plan on being for another 5 years, the cost to refi may not be worth it. So just to, brag to your friends that you've got a lower interest rate doesn't mean, right, it's always worth it. So think
Yeah.
about horizon when you're refinancing and then the costs are associated with it.
Awesome. Thanks, Nick. You left everyone on the panel quiet here because you so thoroughly covered the refinance segment. So we're going to move on and let Nora wrap us up here. And we're just going to tie it out with how do you decide whether to wait, act, or adjust, Nora? So when you're thinking about these decisions, what helps you frame whether you're going to move forward or wait or adjust your current plan?
Yeah, and that's the big question that we get a lot. And I think one of the things we can all agree on is don't solely base your decision on the 24-hour news cycle, right? We can spend a lot of time talking about what is the Fed going to do? They said they were thinking about, all their commentary on 3 interest rate, hikes or reductions, and then all of a sudden inflation increases over the month. We can play around with all those numbers, but the big, you know, main point to think about and consider when you're making these decisions is now the right time for me? Can I control the controllables in the situation rather than referring to what's going to happen, what's the Fed going to do, what's the interest rates going to do to make some of these large decisions? So when you think about is now the right time to buy? Do I refinance? Do I take a larger loan out? A lot of it has to do outside of the interest rates, right? Do you have liquidity? Do you have, what's your time horizon? Can you push this out? If you can you, if you know the amount, can you put that in a more conservative type vehicle? And what does that look like? So those are all things that we can consider rather than just making one decision off of the interest rate, right? Let's look at all the different options that you have and make the decision specifically for you because everyone's situation is going to be a bit different.
Yeah, I had a client last year who was building a new home, and there was a period where they could lock in the rate at any point for about 6 or 7 months. And that client would look at interest rates every single day and reach out to me and be like, should I do it this week? Should I do it this week? What do you think is going to happen to rates? The amount of stress they dealt with over that 6 months, not to mention building a home, is it worth it just to get a few little points here on the interest rate? I don't know. So again, Nick, that was you had a great point on that earlier. Don't sweat looking at rates every single day. It's the right move for your family. Make the decision and move on.
Yep. And there's plenty of room to adjust depending on your goals too, right? So if it's a relatively short-term move or adjustment, right? Like maybe your kids are going to be graduating high school soon, like mine are, and you may move in 5 to 10 years, is a completely different frame of mind than if you're like Nick, Tyler, and Nora that have young kids at home and you're going to be in the same spot for however long, right? So I think, just understanding your own timeline, your own resources, your goals, your objectives, all of that matters so much more than the interest rates, because those will always change and they're completely outside of our control. So just keep it in what you can control and make decisions from there.
And then don't forget about the costs, right? So when it comes to refinancing a mortgage or changing the different investment vehicle, there's a cost that's associated with it. That's why those banks send those letters in the mail every day, right? Because they get paid when we refinance. So don't just brush those costs off. Think, oh, it doesn't really matter. I'm saving a couple percentage points. It really does matter. And so just like everyone said, what's my time horizon? What are my goals? What's it going to cost me? Does this make sense for me and my family? What we would say is don't wing it, right? Give us a call. Let's work together. Let's come up with a good strategy that everyone's on board with, and then we can go execute. That's the best time.
Awesome. Great conversation today, guys. We're going to hand this episode's winner of the week to Tyler, and Tyler's got his 30 to 60 second rant teed up here for us. So let's hear what you got, Tyler.
I don't know if this is so much a rant as it maybe is a cry for help, but I have a 5-month-old right now and I'm not getting a ton of sleep. And, I have a 6-year-old and a 4-year-old as well. I can handle their craziness all day. But when it comes to lack of sleep, that's what I struggle with. So if anyone has any tips or tricks out there, I know there's all sorts of gurus in the baby sleep area. Send them my way. I'd appreciate it.
Yeah, I feel bad for you, Nick, and Nora with the young babies at home that probably aren't letting you get a lot of sleep. I don't envy that situation you're in. But thanks for joining us for another week of Balance Your Wealth. We look forward to seeing you on the next episode.